Good morning, traders. It is Friday, September 19th, 2014, 8 a.m. Chicago time. Thanks for joining me. This Trader Bite is going to cover the usual market analysis, but I also want to discuss some things that I saw over the week, and especially last night with the Scottish vote, trader activities that were taking place that I felt that I should talk about a little bit. So hang in there, and we'll get through this in about 20 minutes. Derivatives trading involves substantial risk of loss that is not suitable for all investors. My personal opinions, market data, and recommendations subject to change without notice. Past performance is not indicative of future results. Quick rundown of the overnight news. As you probably heard, the Scottish referendum went to the no camp. Scotland rejects independence. The overall vote is yes, 1.54 million at 44.6%, and no at 1.914 million or 55.4%. So there's a 10-point spread for the no's. 1.8 million was required to pass this referendum. These numbers do not reflect one council that was yet to report at the time I took this down. The UK Prime Minister's reaction to this says he will grant new power to England, Wales, and Northern Ireland, as well as Scotland, once a balanced constitutional settlement for all of Britain will deliver on devolution of power to Scotland in the next Parliament, which is something he promised as a result of a no vote. Japan's government downgrades September economic assessment, cites weak consumption. So this put the U.S. dollar and the U.S. dollar Japanese yen pair in focus again last night. I'm not sure if you watch it. It rallied through 109. Japan's PM Abe wrote a Wall Street Journal editorial piece that's called "The Next Stage of Abenomics is Coming," but in that piece he does not introduce new measures. So the article was very misleading. The Nikkei erases 2014's losses and strikes a 7-year high as the Bank of Japan's Kuroda gives a green light for further Japanese yen weakness. Again, this caused a reaction overnight between the U.S. dollar and the Japanese yen. So this is something you'll want to watch. I'm not sure if you look at the Japanese yen, but it's a key currency. U.S. Senate approves spending bill to allow support for Syrian rebels and fund government intervention until December 11th. In a landmark bill yesterday through the House, the House of Representatives, for once, came together to pass a bill to support the Syrian rebels against ISIS. So the Senate did its own version of the bill yesterday and passed it as well. So that's nice to see that the U.S. government's functional again a little bit. Quadruple witching today at in about 26 minutes, 25 minutes. The S&P futures will expire. I want to remind you that options continue, the regular options on index futures in the U.S. continue to trade all the way up to 3:15 Central, up to the pit close today. So you may still see some jockeying in there, although it should be minimal. So we have quad witching today, and in addition to that, we have Alibaba's IPO coming out at $68. The company's set to raise $168 billion today, one day. It's insane. Anyway, that's pretty much what I have for you as far as the rundown that could affect the markets today. As far as daily economic releases, the only thing we have on deck today that is of significance is 9 o'clock Central. We have the leading index expecting 0.4% leading index, 0.4% just 30 minutes after the open. Okay, let's look at the market and what we did yesterday. So essentially, What we did is we opened out of value in range yesterday, immediately tested the key LVN above, from above right to the tick here at 2025, and put in an open auction in range. In other words, both sides are active yesterday. It looked like a decent, it's a 3-point swing. It looked like it would quickly succumb to short-term trading, short-term trader control, but it actually pushed off of the 97.25 and broke through to 2003.25 right to the prior day's high, again 2003.25. This makes this high at 2003.25, which looked like a pretty strong high when we ended Wednesday's session. This new high put in above 2002 looked very firm. But then as soon as we tested it in the morning yesterday, 2003.25 again, it became a weaker high. So the expectation for this high here at 2003.25 was for it to break by at least a tick. The market pulled all the way back down into the opening swing. The opening swing was 2000.25. Initially was 50. I put it down at 98.25 to 2000.25, but then when it came down here, I moved it to 97.25. You might have marked the first one I posted, but not the adjustment. It came right back into the opening swing and then pushed right back out and took the that 2003.25 week high. And so from that point on, it's pretty much a chop fest. It put in this 2003.50 high, just a tick above the IB high. It looked like a failed auction on a retest on this rotation here, but mostly yesterday afternoon, the trade was was difficult to read. Short-term traders were in control until the close, and then on the close, it ended up pushing to our key target, which I posted earlier this week and has been on my charts all week, of 2005.50 right here. This is a 200% measured move. I don't remember from where, but I have those posted here. Here it is, 2005.50. It comes from way back here. And then the market came right off and closed at 2004.75. 2004.75 is where it opened yesterday or overnight on the Scottish vote, which I was up and watching at 1 a.m. So we open right against the close, and we immediately go into a push to 2014.50, which was made at about 11:30, and then the market rolled back off once it was clear. I believe the BBC was the first to declare that the Scottish referendum vote had been won by the no votes, and then at that point we had a pullback back to the mid, and we saw the British pound also drop once this information became known. Note the overnight volume is fairly high. It's about twice what it normally is, 251,000, and we have basically what looks like a balanced profile. Point of control at 2011.50. We're trading beneath it. The market's stuck between the mid of yesterday's session and 2001.50. Inventory is clearly, overnight inventory is clearly long, so the expectation this morning is for responsive selling to come in, but we're in new high territory, so there's an elevated probability of an open drive, although open drives into new highs have not been something we've seen recently, so it could be an open drive down. But in either case, I'm looking for responsive selling back to test 2005.50. Yesterday's close, 2004.75, and if it's not able to hold this three-tick range here between 550 and 475, then I'm expecting a bounce and then a choppy ride back up. Remember, leading indicators are coming in at 9 o'clock, so that'll affect things. Leading indicators, the leading index of indicators is important to the Fed for Fed's policy, so you want to watch. It's not a high importance number, but you want to watch how far off it comes in. Okay, that basically summarizes prior day's action. One thing to note here, the data on the close yesterday, very, very strong. So you see it here when it pushed to 2005.50, there was a fair amount of conviction, very strong push on the close. You can also see it in the bigger chart right here. This is a 24-hour chart or an all sessions chart with a delta beneath. I've been using this chart for a long time now to measure the quality of price versus delta. You can see here the delta is a lot weaker than prices, and it's been for almost a year. But with yesterday's run up, the green shaded areas are the day session. The non-shaded areas are the overnight session. And you could see here a nice little pop on this close. We've seen it quite often that we pop up on the close, but yesterday was fairly strong. Even though we had a busy session last night and prices continued higher, look at the delta, it's fairly flat. Even when I expand this scale, there really isn't much to it. It's kind of floating along and really did not overcome the delta that we put in on the close by much. So it's the market continues higher, but the participation is not all that great, and I think it keeps sucking in the short sales, and they're helping push the market higher over time. So that's where we're shaping. That's what we're shaping up to have today. Again, new high territory on the open. It's likely to sustain the gap. Here at 2010 is where we're trading, 2010 and a quarter. We're underneath the 2011.50 overnight VPOC. And also I have the second target, which had a confluence actually, was 2013 and a quarter, and we exceeded that by 5 ticks overnight. I did talk about that. I did tweet out about that last night at about 10 o'clock, that there's a 2013 quarter measured move target that actually has some confluence, has multiple targets here, all within a I think it's a 2 or 3 tick cluster, and I did mention it. The market pushed through it by 5 ticks and fell right back off, as you see here in the overnight. So you can see here, this is the 2013 and a quarter, and it pushed to 2014.50, and it rolled right over and sold off. So that held up pretty good as far as the target's concerned. So that's it. So that's the primary idea. Gap, looking for responsive selling. If we don't get responsive selling, then hypo 2 is that we stand out of the way, and it puts, again, another area. 2175 has multiple confluences between 2020.50 and 2022 and a quarter. There are multiple confluences in this next target as well. So that becomes our next area to watch for a target. Being as we are at 2010, that only puts it about 10 or 11 points away, which is well within range for a rally. So if we fail to go lower, which is what's expected this morning, I'm really expecting it I'm expecting to see responsive selling now that the Scottish referendum news is out of the way. Looking for the market to start to return to auctioning the key areas, and doing that, it would be returning back to the 2005.50 and 2004.75 areas. If it's not able to be held, if buyers don't step in and defend these areas, then we're looking at 2002 for the next test. Fairly balanced profile yesterday, a bit of a jacked up kind of shape, but overall we had the bulk of trading in a Gaussian formation in the middle of the profile. So that's a valid value and valid point of control. So that's what I'm looking at for today. I want to step back for a moment from the technical end of things, because that's what I mostly cover. And in watching, of course, watching risk for stage 5, just watching what traders are doing and making sure, as best as I can, that nobody really blows themselves up on the Scottish news, either trading the British pound or equities. This is the British pound chart, by the way. We've moved from $1.7172 all the way down to $1.6039, and I mentioned yesterday 165, the 165.30 area being likely resistance. This is the point of control here, but also strong coiling action over on at the end of August, and the expectation was for this to push back up into that and then roll over. It didn't quite get to 165.30, but it stopped at 165.15, and you know, once the news was clear that the referendum was won by the noes, it rolled over down to 163.33. The target on the downside for a short against 165.30 for me was this area here, 162.65. Has not quite reached there. The low here, 163.10. So I want to talk a little bit about some things that I see and that I talk to a lot of traders about at Stage 5 during our webinars and in the chat room. I wanted to cover that real quick. I'll take the next maybe 5 minutes to go over this, and I just want, the goal of doing this is to remind everyone of the issues that you have to confront as a trader. This is very typical whether you're trading online as a retail trader or a prop or whatever. These issues are pretty much the same for everyone because we're built the same way. We're educated using the same methods and so forth, and that interferes with the way we trade. Okay, so I want you to listen carefully and see if these things apply to you. The natural response to what we do as traders is the fight or flight response. Now, you've heard this covered probably 1,000 times if you've ever looked at trading psychology. There are many people that talk about it. This response is hardwired into your mind, into the chimp part of your mind, this old, it's called the limbic system. It's a very, very old structure that exists within your brain, and it's designed to help you survive. Okay, it keeps you away from an attacking bear or saber tooth or something. This response is responsible for a lot of what happens for when you trade. The key element to take away from this, and I'm not going to go into trader psychology, the key element to take away from this is that your level of awareness of what you're doing and how you're feeling is key to your survival, in my opinion, as a trader. It's key to overcoming this response. The response occurs without your knowledge. It's a subconscious thing. It's that thing that kind of drives you nuts and forces you to come out and get out of a trade that ultimately ends up working. And the key thing to do is to bring yourself to the present moment awareness. And there are many techniques for this. There's meditation, meditation before you trade, which causes you to be a lot more in touch with the present moment and a lot more in touch with who you are and how you feel and things like that. That's the key. That's the key benefit of meditating. I've been meditating since 1999. And being aware of how you feel and the response that you're having to any particular situation, whether it's a trade that's just sitting there and you're nervous about it, or somebody yelling in your face, or having an argument with a loved one, or whatever, it helps create this core presence that allows you to understand that you don't have to respond. You don't have to respond to it. You don't. You're able to keep your logical mind in play, and you're able to assess the situation and the threat level, and you're able to act from a very strong position. So most of my traders were required to learn how to meditate. If you make yourself aware of where you stand, and it could be as simple as a breathing technique. When you put on a trade, move your awareness from the dome and all the flashing and flipping and all the craziness that happens in a dome that's enticing you to get out of your trade, and bring your attention for a few seconds, maybe even close your eyes for a few seconds, to your internal breathing response. Just listen to yourself breathe, listen to how your body's reacting to the air, how it's expanding and contracting. It helps place you in a present awareness condition so that when you open your eyes, things might look different. Be aware that there's a part of you, there are two parts of you that exist out there. As a trader, you need to be aware of this. There's the logical part, the one that's that processes information and comes to conclusions and stuff, and then there's the emotional part, the chimp brain, the limbic system, that sort of stuff. Just learn to breathe through it. That's one thing I want to convey to you. Again, I'm conveying this to you as someone who's been around traders for a long time and has helped traders, back traders, and I've put traders through the motions of becoming professional and consistent at this. The other thing I see is a complaint that I'm doing all the homework, I'm studying all the charts, I've watched all the webinars out there that anybody's willing to put on, I've looked at charts, I've done the research, I've done all these things, but yet my performance is continuing to be sideways. I continue to sabotage myself. I continue to have a series of 2-3 days that are decent, and then a huge day where I just give up everything. Does that sound familiar to you? If it does, this is a complex issue, but the source of it is the same thing. The key element here to pay attention to, if that's the case, and this is the case for any time frame, whether you're an investor, swing trader, position trader, scalper, whatever, it's people see the same issue. We're all the same. There's nobody here that is special to the market. We're all the same. We're all dealing with the same issues. It's just how you handle these issues, how you redirect your energy is the difference, in my opinion, and my experience as a professional trader, is what makes the difference between a trader who actually gets out of it and a trader that just struggles and ends up pulling their money out of their account and going and doing something else. It's this it's this ability to manage this. Just remember, everyone is really good. Most people, through their training with trading, are very good at figuring out what to trade and what opportunities they want to take advantage of. What most people don't pay attention to is how to identify risk for those opportunities on the fly. Are you someone who's very clear about how much risk you're taking rather than focusing on what the market can do or give you? Start to think in terms of risk. If you start to think in terms of risk, half the battle is eliminating errors, and you start to take away these terrible trades that take away a good portion of your account. Sorry, that's a risk alarm. That take a good portion of your account away without much return. Start to identify the risk first. Start to get good at that, because everybody else, or most people in my opinion, are very good at identifying an opportunity, but they're not very good at identifying the risk. It's really important to do that. This is a game about knowing yourself. Okay, this is a mental game. So spending most of your time crunching numbers and so forth without understanding what your response is a key thing. That's why you can do a lot of homework, you can see the market very clearly, but as soon as you put on a trade, you're not able to manage it properly. And it's because something else kicks in, and it is that limbic system. So be aware that there are two of you trading, and to have a plan. Although you cannot control your emotions, the idea is not to control them. The idea is to become very aware of them and to have a plan for managing those emotions. If there's anything I'm going to tell you that's going to make the largest amount of difference for your trading, that's it. Just be aware. This is why you'll take a trade that is planned, you'll get out, you'll scratch it, or you'll take a 2-tick loss or a 2-tick winner, and you'll see it go to your planned target or see it play out like you expected. It's because the trade was conceived, the idea was conceived under completely different circumstances, mental circumstances, than those that exist while you trade. Important thing to remember. So this is why we define risk, and we only get in once we know that the edge is on our side, and you just let the market play out what it wants to play out. Okay? Good luck to you. Risk always comes first, and I'll catch you on Monday. Good luck. It's the weekend, so trade wisely. Take care.